Welcome to the video tutorial Project Finance Principles of Risk Allocation. The following topics are addressed: the 3 principles of risk allocation, interest orientation, analytical competence, controllability. The video tutorial will be concluded by a list of references and an imprint. Which principles of risk sharing should be implemented in a project finance concept? Sound project finance concepts should implement 3 core principles of risk sharing. The first principle concerns the aspect of interest, or in other words, the principle of interest orientation. Parties should only take risks according to their interests. The second principle concerns the aspect of analysis, or in other words, the principle of analytical competence. Parties should be able to analyze the assumed risks. The third principle concerns the aspect of control, or in other words, the principle of controllability. Parties should be able to monitor and control assumed risks. Why is interest orientation an important principle of risk allocation? The already presented analysis of individual project risks and their mitigation by the various project parties cannot draw a holistic picture of the risk design of a project. It only documents which of the parties involved are affected by the potential advantages and disadvantages of a project financing concept. The result, however, is inevitably incomplete because it does not allow for a final evaluation of the risk design from the individual perspective of a project participant due to the lack of criteria. The project-oriented risk analysis from the perspective of the project or the project company traditionally dominates the literature and focuses mainly on the postulate of a project external risk assignment. Therefore, it has to be supplemented by an interest-oriented risk analysis from the perspective of the project parties. This interest-oriented risk analysis must address the individual motivations of individual parties to assume risk. Otherwise, it remains at the level of a supposedly optimized but possibly unrealistic risk transfer. How can the question of whether there is a fair trade or a community of interest within the framework of a concrete project financing concept be answered? When does a situation exist in which the opportunities and risks are evenly, sensibly and/or fairly distributed between the parties involved? In order to answer these questions, an analysis of the obvious or communicated interests is required. A bank's assessment of the motivation of third parties is an extremely complex task. Nevertheless, an attempt must be made to check the plausibility of the individual interests in order to generate a realistic assessment of the appropriateness of a project-specific risk design. More intensive research should always be carried out if initially only uncertain and therefore not trustworthy results can be derived. Typically, project parties focus on profit, sales, revenues, and/or enterprise value. It should be noted that not all parties focus on maximizing company-specific quantitative targets. On the one hand, there are project participants, for instance governments and local authorities, state export credit and investment insurance companies, as well as development banks, who, due to their function, have to direct their decision towards other non-profit interests, for example fiscal, labor market, industrial, environmental, developmental, and/or other policy interests. Due to their respective promotional mandates, these parties may pursue policies that deviate from the objectives of the commercial lenders and are subject to other guidelines regarding loan collateral, termination rights, project structures under company law, and environmental standards. On the other hand, even strictly market economy-oriented companies can, for strategic reasons, participate in risky and thus potentially unprofitable projects. The aim is, for example, to secure or expand their market position in the medium to long term. In such cases, further objectives such as market power, diversification, reputation, etc. are set in order to maximize profits, sales, and/or value. The principle of interest orientation demands that the commitment of a project party is analyzed and assessed against the background of the individual interests of this project party. Commitment can be interpreted as the anticipated sustainable willingness to comply with the assumed obligations. Why is analytical competence an important principle of risk allocation? The preferences of individual parties which have been obtained in the course of the analysis of the interest orientation cannot provide a complete picture of the risk design of a project financing concept. The question also arises whether the individual project participants are actually able to assess the quality and quantity of the risks assumed. What is meant here is not the competence to carry out a risk analysis in accordance with certain minimum technical standards. Instead, the ability to analyze the assumed project risks depending on the following three aspects become relevant. The first aspect is the risk type. Can the parties assess the type of risks to be assumed? The parties must have the ability to make an objective assessment of the type of risk to be assumed. As a rule, the suitability for analyzing a specific risk should correspond to the intended function of a project participant. Exceptions may be made where the direct assignment of risk or the indirect relationship to risk goes beyond the functional context. This can be the case, for example, if the sponsors assume lump sum additional payment obligations or if other project participants provide guarantees for atypical imponderables. The know-how available to these parties would then have to be evaluated against the background of the risks to be taken over. The second aspect is experience. What are the individual experiences of the respective project parties? The ability to analyze must be assessed against the background of the individual experience of a project party, in other words, its track record. For example, an EPC contractor may be fundamentally capable of assessing the completion risk if he has successfully completed a sufficient number of similar projects. However, if his experience is limited to projects with different process technologies, different specifications and dimensions, or non-comparable regional geographical conditions, a differentiated assessment of his actual analytical capability would be necessary. Moreover, as central project participants, the sponsors and lenders should have a certain minimum of generalist experience in the analysis of project risks. The third aspect is time. Can the parties assess the risk over time? Project financing concepts regularly imply a multi-year project life cycle which typically covers the entire economic life and can therefore extend beyond the planned credit period. Project parties carrying risks must take into account that the parameters do not remain static over time, but are always subject to dynamic change processes. In this context, the ability to analyze means the explicit consideration of potentially uncertain data sets by a scenario-based processing of project imponderables. In conclusion, the principle of analytical competence requires the following. In the context of a project-related risk analysis, the ability of each project party to analyze the potentially assumed risks must be examined. Why is the ability to control assumed risks an important principle of risk allocation? The principles of interest orientation and analytical competence are insufficient if the aspect of controllability is disregarded. Parties who assume risks to an extent corresponding to their own interests and are able to analyze them are not automatically able to fully control these risks. Therefore, the following aspects have to be considered. First, the activity level. What is the desired level of activity of risk-bearing parties? Project risks can be controlled or managed actively by risk avoidance and passively by risk mitigation or risk hedging. Thus, the decisive factor in assessing the ability to control is the desired level of activity of an involved risk-bearing party. This means that the understanding of the word control must first be clearly defined. The second aspect is influenceability. To which extent can risks be influenced by risk-bearing parties? Due to their nature, project risks can only be actively influenced to a limited extent. In the extreme case of force majeure, a complete inability to control may exist. In the case of other risk groups, the individual sub-risk will have to be examined. The purpose is to determine the extent to which the individual risk can be actively controlled by those involved. The third aspect is integrability. Can qualified parties be involved in the project? It will not always be possible to involve the party that can control the risk most effectively based on its experience. In other words, its track record and/or position. The fourth aspect is compatibility. Does the ability to control coincide with an adequate credit rating? It is possible that the party that can control a risk most effectively will have insufficient creditworthiness. Therefore, it will not be able to finally absorb the risk. In such cases, other parties would have to be involved in order to ensure that the risk is covered. The attributes of controllability and economic viability thus automatically fall apart. The above aspects show that controllability cannot represent a normative standard per se. The principle of controllability only means that the project-oriented risk analysis must examine which of the parties involved can actively or passively control the assumed and/or other project risks.